Our recommendations on the sin or the demerit rate is very much basically based on what happens currently. De facto, current some of these goods are taxed at close to what we're recommending.
Yeah.
So we're not changing anything, and so we're not increasing any existing taxes or saying that more goods to be added. We're just codifying the status quo, and there the finance minister is right that if today itself you're taxing some of these things at high rates, then if you put in the constitution a cap, how would you then even be able to continue with the status quo?
But speaking of the status quo, so again, just for the sake of clarity, for instance, as far as cigarettes are concerned, the demerit rate of 40%, does this mean that the centre's excise part will be subsumed as far as the CGST is concerned?
No, see, I think on tobacco products, the situation is that tobacco products will be part of the GST structure, but the centre will be able to levy top-up excises over and above the GST.
So that means 40% plus then?
Yeah, whatever it is. No, again, that's a call they have to make. So if, for example, the centre has to tax more, the broad aim would be that it wouldn't be much greater than what it is today. So tobacco goes into the structure of the GST, maybe at a standard rate or whatever, and then anything over and above that the centre can do as part of the top-up. So I mean, the point is that no increases in tax rates per se are envisaged. If anything, as you said, manufacturing tax rates are going to come down substantially as a result of this. Because the standard rate is going to come
lower.
Down. It's lower, exactly.
Yeah.
It's going to be lower.
So you're saying it's essentially status quo then as far as things like cigarettes are concerned, because I mean the markets are reacting negatively, trying to understand the demerit rate.
We've not recommended anything at all to suggest increases in any of these rates. We're just codifying what the status quo is.
Okay, let me come to the other controversial aspect, and of course your recommendation is aligned to the Congress Party, and you have suggested that the 1% interstate tax is done away with, and just about everybody agrees with that because of the inflationary impact. But do you believe that it is going to be, and the cascading impact, and do you believe that it's going to be easy to get for instance, the states of Tamil Nadu and Gujarat on board? Gujarat, I would imagine, is easy, but Tamil Nadu on board, by doing away with it?
I want to say that the main reason to eliminate that is, in fact, to realize the Make in India vision. As we say in the report that, you want to make in India by making one India, because what these things actually do is to favor production overseas relative to production in India. And why would we want to do that? And why would we want to do that? We're not doing that by raising our barriers to overseas, but here we're in fact subsidizing overseas production, and that's what we want to eliminate. Now, as for the politics of this, it is what it is, going to play out what it is. But we do have some, illustrative analysis and calculations in the report, which kind of show that by and large, the manufacturing states are also going to be big consumers of services. So we don't envisage, at least based on our tentative analysis, that there's going to be some major reshuffling of the tax base.
Let me ask you about the inflationary impact now, and lots of reports that are now sort of back of the envelope calculations that we could in fact see CPI go up by between 45 to 60 basis points, because you will see the service tax rate go up, assuming to 18% from the current 14.5%. And the assumption again is that because the CPI basket is made up largely about 30-odd% of the service side, but you've said that the inflationary impact should be minimal. Are you assuming the offset on account of the goods sort of coming down?
Yeah, I think that we've actually done a very careful analysis of the impact on the CPI, very carefully done, and I think the assessment is that under the the two-rate structure, that there'll be virtually no impact on inflation. Because remember, you have to start with the point that by definition a revenue neutral rate on aggregate should be inflation neutral. That's why it's revenue neutral, right? But there could still be distributional consequences, because after all, you are moving to a different kind of tax in terms of, the distribution of who currently pays the tax and who might pay it in the future. You go from a production to a consumption, from manufacturing services. So that's why we had to also look at the distributional impact, and the distributional impact also comes out to be, very, very, benign in terms of, a lot of the CPI is food and stuff which is already exempted. A lot of services also are exempted, actually, health, education, and so on. So that's why I think we find that overall the inflation impact is going to be very minimal. But of course, we also say that, the experience in other countries shows that, sometimes potentially inflation can go up. So what we've also urged is a kind of mechanism for monitoring to ensure that both at the central and the state levels, to ensure that, you don't actually see these price increases on the ground.
Let me talk to you about the revenue neutral rate and the standard rate now. As far as the revenue neutral rate is concerned, you said you wouldn't have liked to give a range, but you've been forced in a sense to give a range of between 15 to 15.5%. Standard rate 17 to 18%. Now a lot of this assumes the fact that the government is going to move away from the exemption Raj, as you called it, 300 exemptions at the centre's level, 90 at the level of the state. What happens to the standard rate if we don't really move towards phasing out the exemptions as you envisage?
That's a good question. Firstly, I just want to clarify that, we've given a range not just because, we didn't want to be prejudging what the GST Council want to do, but I think it's an admission that this is genuinely a kind of it's not something that you can say with any degree of confidence that this one rate is the right rate.
Sure.
Lots of assumptions go into it and so on. So I think that's why we've given a range. But in response to your question, I think it's just a simple matter of arithmetic. It's not politics, it's not anything that the more you exempt, the higher the rates have to be. That's it. And that's something that the political process will have to recognize very, very clearly. There is no free lunch in this.
No, there is no free lunch, and hence I ask, is the 17 to 18% really in that sense likely to be the number that we go with unless we actually see a significant phasing out of the exemptions?
So remember that the report is based on the assumption that what has already been kind of agreed in the council, which is in the empowered committee, that the centre's 300 would go to 90. So we are not prejudging that at all. It's based on that assumption per se. So that's why I think that we think that ours is a kind of realistic estimate of that.